Hello, everybody. Ben Rains here. I'm a stock strategist at Zacks, and I also run the Alternative Energy Innovator Service. Today, we're exploring three best-in-class nuclear energy stocks to consider buying at some attractive levels and holding for long-term upside. The goal today is to start looking at the stocks that stand to benefit from the soaring AI energy demand and the broader US and global push to bring more clean, reliable nuclear power online as quickly as possible to become abundantly energy independent, which is key to thriving growth economies. Three stocks we're exploring today are Constellation Energy, which trades under the ticker CEG, Vistra, which is VST, and then Talen Energy, which is TLN. Before we dive into these three nuclear energy stocks to buy and hold, let's quickly make the case for why it's time to start adding stocks beyond the soaring AI and chip stocks. Okay, so now we are in our ZRS system here looking at the iShares Semiconductor ETF, which is SOXX. And we can see that it's really just skyrocketed off those March lows. The stock is up around 95% between March 30th and June 4th as I'm recording this. It has it at its most overbought RSI levels in the past 10 years. So eventually, there's only so far stocks can climb before they face some selling pressure and healthy, which is why gravity is eventually going to take over. Thankfully, the bull case for the AI boom remains firmly intact, and the hyperscalers are prepared to spend upwards of $800 billion in capex in just 2026, and that figure is projected to climb again in 2027. That means that investors should remain optimistic about the larger AI megacycle and take advantage of the next AI driven drawdown. But it's time to start focusing possibly on industries outside of AI that have not soared as much as some of these AI and chip stocks. Because as I said, eventually kind of buying at this level, it could go on in the near term, but eventually there's going to be a little bit of market gravity and we're going to see somewhat of a drawdown or a pullback. But as I said, the overall bull case for the stock market remains firmly in place. We're now here looking at our director of research. This is Shraz Mian's weekly earnings commentary. So overall, I'm going to show this real fast. Overall earnings for S&P 500 are expected to grow 20% year over year in 2026 on 9.3% higher revenue. And then we're calling for 16.7% earnings growth next year in 2027, and then 15% growth in 2028, which would blow away 2024 and 2025. So this is why all the bulls and all the Wall Street bulls are still trying to get on the right side of a possible long-term upswing in 2020, the back half of 2026 and beyond. As I said, just with this earnings growth we're looking at here alone. And it's also worth noting, I'm going to go down to page 18 here and show that it's not just the AI and chip stocks. Every single one of the 16 Zacks sectors, if we're looking here at earnings, this is annual earnings, is expected to post a year-over-year earnings growth. So look, if we go down this list, every single one, from consumer staples to consumer discretionary to retail to autos, basic materials, every single thing is supposed to have a year-over-year growth. So it's worth noting that it's not just AI and chip stocks that are driving this long-term earnings growth in 2026, 2027, and beyond. So with that in mind, that's why we really should be buying stocks in 2020, the back half of 2026 and to start June, even though we might not want to chase some of these high flying chip stocks. So now we're going to take a quick look at kind of the broader bull case for AI energy, is specifically nuclear. And then we'll dive into those three stocks that I talked about up front. So simply put, there won't be an AI age without more power. The most important new phrase in Wall Street is that you can't print electrons. Electricity is made of electrons flowing through the grid. So tech giants and AI hyperscalers such as Microsoft are pouring billions and billions of dollars into chips and servers and more and getting tangible results rather quickly. But they cannot, however, throw money and generate the massive amount of new electricity required to power all of their huge AI growth efforts overnight. Data centers consume as much electricity as mid-sized cities, these AI hyperscaler data centers. In AI growth alongside reshoring and the energy transition is expected to drive a 25% increase in US electricity demand by 2030 and 75 to 100% growth by 2050. This is straining the grid after decades of underinvestment, with dispatchable power supply expected to lag demand through at least 2030, if not beyond. And this is why the hyperscalers have all made long-term power agreements with nuclear energy companies, because they crave the clean, always-on reliability of nuclear power. that's provided 20% of U.S. electricity for the last 3 decades. We can see here the nuclear power has by far the highest capacity factor of all energy sources. And this is in 2020, but that has continued over the last 6 years, well above geothermal, well above natural gas, and miles above wind and solar, which are those intermittent sources. And it's worth noting that the US government under Biden and now Trump, so highlighting bipartisan support, are attempting to spur nuclear energy growth and a revival after decades of stagnation or really just underinvestment. The Trump administration is aiming to quadruple nuclear capacity by 2050. And as I said, all of the hyperscalers are going all in on nuclear energy as well. And on top of that, natural gas is another big winner in the near term. We can see that it's also got a high capacity factor, and it's easier to roll out in the short run with some of these nuclear projects taking a little bit longer. So natural gas is set to be another winner, especially in the near term. It's cleaner than coal as coal falls out of favor, and it's more reliable than intermittent sources like wind and solar. And the AI hyperscalers are now going all in on long-term natural gas deals as well. So now we're going to go over and start with the bull case for Constellation Energy. We can see here, this is ticker, we'll get into the ticker, it's CEG. It is one of the largest independent power producers in the US, meaning it generates electricity and then sells it into wholesale markets and directly to consumers. It helped kickstart the growing relationship between AI hyperscalers and nuclear power with its 20-year power purchase agreement that it landed with Microsoft in the fall of 2024. Since then, it's expanded its AI hyperscaler portfolio, and it completed a $27 billion deal to buy natural gas and geothermal powerhouse Calpine in early 2026. The move further expands its footprint into Texas and into California for the first time, cementing its standing as one of the energy companies of the 21st century. So you can see here, this is its map. It's now with the Calpine deal deeply in California, growing its footprint in Texas, hugely in the Northeast, and as well as Illinois and some of the Midwest. So the AI hyperscalers and the U.S. Energy Department are helping Constellation restart nuclear reactors that were shuttered for economic reasons and pursue its next generation small modular reactor ambition. So that's that SMR you might hear about a lot in headlines. Earlier this year, it raised its dividend by another 10% in 2026 as part of a plan to consistently boost its payout. It also reaffirmed its 2026 earnings per share guidance range back in May, and it expects overall to grow its earnings per share by 20% or more from 2026 through 2029. So now we're going to jump into a little bit of Constellation. So we'll put in this ticker here, CEG, and show where we are at the moment. So we'll go to the last 3 years. So we can see it's already put in a trend line here. It's trying to hold its ground here. I'm going to put in candlestick charts. So if we look here, right here, this huge gap up is that Microsoft deal from the fall of 2024. It has been holding that level recently. We can see it held there several times to start 2026. That's the level that the bulls are trying to hold. It's the level, if you're interested in Constellation, that you might want to consider dipping your toes in now. And if it falls below that, maybe it's pre-Microsoft highs from 2024 would be a level to get in at the moment. But we can see the stock has done pretty well over the last few years since it went public. We'll do it versus its econ sector here. So we'll go the last 5 years. We can see it went public in early 2022. So it's up about 400%. And we can see, we'll go here, it's trading at about 35% below its all-time highs. And then if we look at its valuation, it's trading about 45% below its peaks at more reasonable valuation levels. So it's trading at 21.3 times forward 12-month earnings. And we'll go ahead and take a look at Constellation here in terms of its trading. Its average Zacks price target offers 39% upside from its current levels. We can see that Wall Street's still very high in the stock. So of the 20 brokerage recommendations Zacks has, 15 are sitting at strong buys, 1 buy, 4 holds, and no sells. We'll go ahead and then take a look at its earnings revisions. So it's stagnated a bit recently, which is why the stock is kind of chopped around, but it's trending in the right direction. So certainly worth putting Constellation Energy on your radar. It pays a dividend. It's going to grow its earnings significantly over the next several years, and it's making deals with hyperscalers, and it made that blockbuster deal for Calpine that really sets it up to be one of the energy companies of the 21st century and possibly beyond. Now we're going to move over to Vistra, which is also one of the largest competitive power generators in the US with a best-in-class portfolio spanning nuclear, natural gas, solar, and beyond. It has two separate 20-year power purchase agreements with AI hyperscalers. One's with Meta and one is with Amazon that cement that nuclear energy and natural gas upside. It owns and operates the second largest competitive nuclear fleet in the US behind Constellation. And its growing portfolio via natural gas deals are helping it supply that AI data center power that all these companies need as quickly as possible. It operates mostly in Texas, California, Illinois, and then most of the Northeast. So huge growth areas of the United States. And it says it operates in all major competitive wholesale markets in the US, which is key. And it has $1.5 billion remaining under its existing share purchase authorization, which is expected to be utilized through the end of 2027. So it's continuing to buy back stock. It's also consistently lifted its dividend while maintaining a pretty low payout ratio. We can actually show you that here. We go to dividend history as it loads. We can see that its payout ratio is just 12%, so super low, which is a great sign. And the company reaffirmed its 2026 outlook when it reported early May, so that's another great sign. And we'll change it up a little bit. We'll start here with its outlook. So we're calling for about 30% revenue growth in 2026, and then 12% revenue growth in 2027, and then massive 77% adjusted earnings growth in 2026, followed up by expected 20% growth next year, which is really impressive for a company of its size. And we can see its earnings revisions are trending in the right direction for 2027 and 2026, with a little bit of downward momentum for 2028. And we can see here it's trading. Its average Zacks price target offers 52% upside from its current levels, and 16 of the 17 brokerage recommendations that we have are sitting at strong buy. So Wall Street still really loves the stock. And we can see here where VST is trading in terms of, it's actually trading at a 55% discount. If we look over the last 5 years, it's trading at a 55% discount to its highs at just last decade too. It's traded really high. It's trading at 15.2 times forward 12-month earnings, which has it almost in line with its broader sector. And we'll go to the performance as well here. So, VST is on a massive run. Let's go to the last 5 years. It's up about 773%, but it has chopped around recently, which if you missed this massive ride, might set up a good opportunity to buy. It's currently trading around 30% below where it was in the fall of 2025. So its highs were in September of 2025. We can go to a technical chart here to take a look at VST. Okay, now we're looking at the technical chart here for VST. We can see this is the green line. It's trying to hold its 50-day moving average. We can even go closer. We can go year to date to give a sense. It's been chopping around at these levels, and we go over the last year as well, just to be a little bit close. It's trying to hold that line, and then we'll go actually over the last 2 years as well. And this is just if you're looking at any technical ranges, we can see it's trying to hold some of this kind of breakout level from early. This is a year ago, essentially, when it broke out above those previous highs. So it's chopped around for the last year plus, kind of like Constellation, and then the last stock we're going to look at as well. So it's a good sign as the market's at all-time highs, and some of these AI and chip stocks are at super bloated and over heated levels, that VST is looking like a solid opportunity as it tries to hold its ground at its 50-day moving average. And then we can put in some various levels as well if you're focused on the technicals. But overall, certainly worth considering VST for all of these reasons we talked about already. It's sure to be kind of a longer term winner in this broader AI energy with a focus on nuclear and natural gas, returning value to shareholders via dividends and buying back its own shares, and also working relationships with Meta and Amazon and expanding that AI data center profile as well. And so the last of the stocks we're going to look at today is Talen, which trades the ticker TLN. It's Talen Energy. Like its peers, Talen is a leading independent power producer. And TLN, like Constellation and VST, is kind of at the vanguard of the relationship between AI and nuclear. It was actually one of the first companies to announce all the way back in July 2021 its plans to build a AI data center at its Susquehanna nuclear plant. And since then, it's had a growing relationship with Amazon. It's continued to grow that relationship as well. And it's also aggressively expanding through natural gas deals. It's added roughly 5.5 gigawatts of power for natural gas to boost its generating capacity to about 13.1 gigawatts. And that's all just over the last 12 to 18 months. And its natural gas deals during this stretch are set to boost its free cash flow per share by over 40% in 2026 and then over 50% through 2029. Back in May, Talen reaffirmed its 2026 guidance, and it said its goal is to add as much natural gas and nuclear power as possible as part of its longer-term flywheel strategy for powering AI hyperscaler data centers. And then speaking of that, it said there's further upside, quote, from acceleration of the Amazon ramp up in its existing deal, its power purchase agreement, and then plus potential for new data center contracting opportunities going forward. So I'm going to go ahead and take a look at Talen. So we already here, we see that its average Zacks price target offers 26% upside to its current levels. And then we can see that Wall Street's still very high in the stock. We only have 2 holds, 1 buy, and then 11 strong buys out of the 14 brokerage recommendations that we have. Go ahead and take a look at its detailed estimate page as well. The company is expected to grow its revenue by 65% in 2026 and another 17% next year. And then on the bottom line, we're calling for a whopping 270% adjusted earnings growth to go from $6.17 per share all the way up to nearly $23 per share, and then another 31% growth next year. We can go ahead and take a look at its earnings estimate revisions page as well. So it's only been public for a few years. Its 2026 and 2027 revisions have trended higher relatively, though they're a little bit stagnant recently, which is a reason why the stock, as we're going to look at here in a second, has stagnated, but which is why it might be a time to buy TLN, like it might be a time to buy VST and CG as well, given the long-term upside as it sits below its highs. So we can see that it hit its highs back in October. So we'll go ahead and take a look exactly at that. That was, I think it was 10.1, 10.8-ish. So it's trading, let's see, it's trading at about 15% below those October 8th highs. So as the market, it's at all-time highs. It's trading 15% below its highs. And we'll go ahead and take a look at its technical levels as well. It is holding on to that 200-day moving average. That's the red line right here. And then it has held the line at a breakout level. Go ahead and draw a trend line here. Trend line here from where it's held its ground. This is the orange line, so that's those breakout levels from last July. It's held it there several times throughout 2026. It's currently trying to hold its ground again at that 200-day, as it's been kind of stuck in this little bit of a holding pattern for the last 6+ months. So it could be due for a breakout, especially if the market starts to rotate out of all of these soaring AI and chip stocks and into some possibly undervalued plays at the moment. We'll go ahead and take a look at its valuation levels here as we close out our bull case for all 3 of these long-term nuclear energy and natural gas stocks to consider buying. And we can see that TLN is trading at just 14.7 times forward 12-month earnings. And since it's a newer public company, its earnings are a little bit, some of this chart might look a little bit funky. It's traded as high as 76 times over the last 2 years. So now it's closer in line with its oil and energy sector overall at 14.7 times forward 12 earnings. So a value stock there as well, kind of like all 3 of these stocks are, that are these long-term AI energy and kind of the next generation of energy companies to buy and hold in the 21st century. And that does it for me. Thanks so much for watching.